Have you checked your retirement tax strategy this year? Because while most retirees were focused on inflation, healthcare costs, and protecting their savings, several important tax rules changed quietly in the background. No special announcement, no letter in the mail, no simple explanation sent to retirees. And that's exactly why many people may never realize these changes could affect their retirement finances. Some of these updates may create new opportunities to reduce taxable income. Others could affect Medicare costs, estate planning decisions, and retirement tax strategies. Today, I'm breaking down 5 important tax rule changes every retiree should understand, what they mean in plain English, and the practical steps you should consider taking. And one of these changes could be worth thousands of dollars over the next few years. As always, this video is for educational purposes only, and should not be considered tax, legal, or financial advice. Tax laws can change, and every situation is unique. Always consult a qualified professional regarding your specific circumstances. Let's get started. Let's begin with the change that's getting the most attention. Starting with recent tax law updates, many taxpayers age 65 and older may qualify for an additional deduction beyond the standard deduction already available to seniors. For some married retirees, this could significantly increase the amount of income shielded from taxation. Think about what that means. A larger deduction generally means less taxable income, and less taxable income can potentially reduce your overall tax liability. I recently spoke with a retired couple who assumed their tax situation would remain largely unchanged from prior years. When they reviewed the updated rules, they discovered they qualified for a larger deduction than expected. The lesson? Never assume last year's tax strategy is automatically the best strategy this year. Tax rules evolve, and retirement planning needs to evolve with them. If you're over 65, review your most recent tax return and discuss any new senior-related deductions with your tax professional. This is one of those changes that's easy to overlook because it happens quietly. For retirees who own homes in higher tax states, this next change deserves attention. For years, many taxpayers faced strict limitations on how much state and local tax payments could be deducted. That limitation affected property taxes and certain state tax obligations. Recent changes have increased those limits for many taxpayers. Why does this matter? Because deductions that were previously unavailable may now become relevant again. I've seen retirees continue filing the same way they've filed for years without revisiting the numbers. That's understandable. Most people develop habits. But tax planning should never run entirely on autopilot. If you own a home and pay significant property taxes, this is a good year to compare. Standard deduction, itemized deductions. The better option may not be the same as it was several years ago. Whenever estate tax rules make headlines, many retirees immediately assume the topic only applies to the ultra-wealthy. In reality, estate planning affects almost everyone. Recent changes increased federal estate tax exemption levels and created greater long-term certainty for many families. For most retirees, this means federal estate taxes may be less of a concern than they were previously. But here's the key point. That doesn't mean estate planning becomes unimportant. Far from it. Many states have their own inheritance tax or estate tax rules that differ from federal law. Years ago, I worked with a family that spent months worrying about federal estate taxes. After reviewing their situation, we discovered their primary planning concern was actually at the state level. The federal rules weren't the issue. The state rules were. That's why comprehensive planning matters. Always understand both the federal and state side of the equation. Rule change number 4. Medicare income thresholds have increased. This next change could affect healthcare costs. Many retirees don't realize that Medicare premiums can be influenced by income levels. Higher income retirees may pay additional Medicare-related costs depending on their reported income. Recent updates increased certain income thresholds. At first glance, that sounds like a technical adjustment, but it can have meaningful financial consequences. Why? Because retirement income often comes from multiple sources: Social Security, pensions, IRA withdrawals, investment income, capital gains, and small decisions can sometimes influence where you fall relative to important Medicare thresholds. One of the most common retirement planning mistakes I see is focusing exclusively on taxes while ignoring healthcare costs. The two are often connected. Before making major withdrawal decisions, it's worth understanding how those decisions could affect both taxes and Medicare expenses. Rule change number 5. New opportunities related to vehicle loan interest. This final change is one many retirees haven't heard about. Recent tax law updates created potential deductions related to qualifying vehicle loan interest under specific circumstances. Now, the rules are detailed. Eligibility requirements matter. Income limitations may apply. Vehicle qualifications may apply, and not every taxpayer will benefit. But the larger lesson is important. Many retirees assume certain deductions have never existed and never will. Then the rules change. That's why staying informed matters. If you've recently financed a vehicle or plan to purchase one, discuss available deductions and eligibility requirements with a qualified tax professional. A simple conversation could reveal opportunities that weren't available previously. What these 5 changes really mean. When you step back and look at all 5 updates together, a bigger pattern emerges. Retirement planning isn't just about investment performance. It's about understanding the rules that affect taxes, Medicare costs, estate planning, deductions, long-term income management. The retirees who tend to keep more of their hard-earned money aren't necessarily the ones with the largest portfolios. They're often the ones who stay informed. They review changes, they ask questions, they adapt, and they avoid assuming that yesterday's rules still apply today. The action plan. Before this week ends, consider doing these 5 things. Review your most recent tax return. Confirm whether you qualify for additional senior deductions. Compare itemized deductions versus the standard deduction. Review Medicare income thresholds before making major withdrawals. Revisit your estate plan and understand your state's rules. None of these steps require drastic action, but together, they can help create a stronger retirement strategy. Retirement is complicated enough without hidden tax surprises. The good news is that a little awareness can go a long way. Understanding these 5 tax rule changes won't solve every financial challenge, but it can help you ask better questions, make better decisions, and potentially keep more of the money you've spent decades working to earn. Which of these 5 changes surprised you the most? Let me know in the comments below. If you found this video helpful, subscribe to Decoding Finance for more retirement planning, Social Security education, tax awareness, Medicare insights, and practical financial strategies designed to help you make informed financial decisions. Thanks for watching, and I'll see you in the next video.